My name is Joe Lowry. This is Cale. We're with Lowry Financial Advisors. It's been a while since we've done one of these videos, and we wanted to talk a little bit about what's going on in the world and how someone should maybe think about it. So, Cale.
What is going on in the world, specifically the markets?
Good question. So, things are bad, right? It's been a... What?
It's not that bad. Keep going.
This has been a bad year for the markets, by any measure.
But it was a great year before.
Yes. So a bad year coming after many good years. It's important to be grateful for those good years when they happen and to have the proper perspective for the bad. And as an investor, we should be expecting ups and downs, right? It's not a bug, it's a feature of being an investor. And so when we're looking at a year like this where market values have declined, it's important to think about not so much market values, which are a result, but what is the source or the cause, the underlying causes of those market values. And it's easily understood, or more easily understood, if we think about it in terms of earnings and valuations.
Okay, so what changed about earnings and valuations this year?
Well, in terms of earnings, not a lot has changed. I mean, there's been a little bit of a decline in earnings being the profits that public companies earn. Earnings have still seen, I think, for the most part, still on average, an increase over previous periods, but the rate of increase has slowed. So earnings are growing, but not as quickly as they were before. The real issue here has been valuations, and valuations have been heavily affected by the increase in interest rates. This matters because as interest rates go up, certain assets like bonds that were less attractive before because they weren't paying out an attractive amount of interest, now all of a sudden they are. You can buy treasury bills, a very short term, paying 3%, right?
Yeah, over that, yeah, more than that.
Yep. So something you wouldn't have looked at before, you can look at now, and that's a reasonable alternative to something with higher risk. And a lot of it too is the source of the interest rate increase. The Federal Reserve hiking rates is likely to have an impact on economic growth. It already is.
Yes, because borrowing money costs more, and it just takes more to move those earnings numbers.
Right. And we're really seeing it in one area in particular, which is housing, where you're already seeing the cost to buy a home is a lot higher because mortgage rates are higher. And so there's just going to be less movement, less money available, taken from homes, being able to be used in other areas, or maybe to improve your home because you have to pay more for it. So that becomes less attractive. And so the increase in interest rates is starting to have an effect on the economy. And if it slows economic activity in the way that it has already started to, then earnings will be affected. Companies will earn less, and people will be also less willing to pay what they were before for those.
So some of this decrease in valuations of the stock market, kind of anticipating this potential economic slowdown?
I think that's what we think, right? Investors are concerned about the future. They're concerned that companies are not going to be able to provide the level of earnings that they would want. And so that's when that money goes elsewhere, goes to cash, goes to less risky assets that are now more attractive than they were before. Cale, what does this mean for the everyday investor?
Well, it depends.
Exactly.
If you have set up your portfolio for a long growth horizon, then this is just one of the many investment decline periods that you will face over a long period of time.
Yep. So when we think about the prospects of a recession or economic slowdown, it's important to look at your life and say, is my income or other circumstances going to be affected if the economy does slow down, if we have a recession? In a recent blog post, our friend Brad McMillan wrote something that I thought was applicable to a lot of the people that we work with. As investors, we need to keep focused on our goals, which have not been affected by the recent pullbacks, and pay as little attention as possible to the bumps along the way. Yes, the volatility is scary, but this too shall pass. And I think that's the end message we wanted to convey today, is that if your goals and circumstance have not changed, then there's really no reason to abandon a good long-term investment program. Just a reminder that this video is intended for informational purposes only and should not be construed as an offer to buy or sell a security or investment product. In all things related to money and finance, you should consult your financial advisor. If you have any questions about your specific situation,
Call Joe.
or Cale, or the other Joe.
Yes.
All right. Thanks for joining us today. We'll see you next time.